So in a perfect world, that's what we'd see here. We see gold pull back with the stock market over the next 4, 5, 6 months, and then gold would probably be off to the races after that. So short term, you don't want to bet against it. It's still bullish, but when you look at the big picture, all the signs are there, including these monthly charts, these candle wicks. If we just zoom in, when price runs up and then gets slammed down and then runs up again and gets slammed down, that's usually a sign that the market is a little bit exhausted. And the big question is this an exhaustion move and it's going to break down and unwind like I think it might? Or is it just a pause, a consolidation before it pushes up for that next leg higher? And
gold is rapidly gaining traction across global markets as both institutional and retail investors shift their focus toward the yellow metal amid growing economic uncertainty. The U.S. economy, once bolstered by the dominance of the dollar, now appears to be leaning toward gold as a more stable store of value. This trend is being further fueled by escalating trade tensions, particularly under the aggressive trade policies of former President Donald Trump. His imposition of sweeping global tariffs, followed by the replacement of elevated duties with a blanket 10% import tax, has contributed to a broader loss of confidence in the U.S. dollar. The result has been a widespread dollar sell-off, as investors and governments seek alternatives. Central banks around the world are now actively diversifying their reserves away from the dollar, a move that has led to increased volatility in the U.S. dollar index. As the greenback weakens, gold has emerged as the clear beneficiary, with demand rising steadily. From a technical standpoint, gold continues to show strength. Market analyst ChrisVermeulen notes that despite a brief pause, the metal remains in a long-term bullish trend. Chart patterns and Fibonacci projections suggest that gold could potentially climb to around $3,750 per ounce in the coming months. Deutsche Bank also supports this outlook, forecasting that gold may reach $3,700 by 2026, driven by persistent inflation concerns, geopolitical instability, and continued de-dollarization. Although gold has recently retreated from its all-time high of $3,500 an ounce, the metal is still holding a firm support level around $3,200. This resilience is discouraging investors from taking short positions, even as bullish momentum temporarily wanes. Vermeulen cautions that while the short-term trend remains positive, the longer-term picture may be approaching a point of exhaustion. He advises investors to stay cautious, as the upside potential appears limited in the immediate term, while downside risks are beginning to emerge. Analysts at TD Securities echoed this sentiment in a recent note, highlighting that gold continues to trade well above its previous lows, despite the volatile backdrop created by Trump's Liberation Day announcement. This sustained strength suggests that gold's role as a safe haven asset remains firmly intact, even in the face of shifting policy and market dynamics. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think gold was a little bit of a crowded play. I think the whole kind of world economy, when they get nervous, they move to gold. So that is, that's where I think a lot of emotional money has been moving. And there's been a lot of FOMO. A lot of people I talk to who aren't in gold have been painfully watching it go higher, and they all want to get in. And so I think we're just seeing some profit taking. We've had the news with the tariffs, kind of another delay, a pause of tariffs. And so that is strengthening the U.S. dollar. The dollar is going up, so gold's falling in kind of the inverse relationship. So we're just seeing, I think, some profit taking, people moving out of that play, thinking there might be some good news that come out of the China tariff deal down the road. So I think it's just that everybody who piled in is now nervous, and now they're kind of quickly pulling back the reins. And, whatever moves up the most is usually the one that pulls back the most. And gold has definitely been outperforming. Silver has been struggling. And so that's, I think, the reason for silver really just holding its ground today while gold kind of takes a bit of a beating. If we take a look at the gold market, if we pull up gold here, gold has had a very nice move. It's recently pulled back. We've been slowly kind of actively trading this. We did get into a gold trade. We closed some out a few days ago, and gold has kind of made this, is having a pause. This is a significant level. Gold could still consolidate here and move up based on the charts. Gold has the potential to rally to $3,750. Which is a substantial move to the upside from where we are right now. That's somewhere up to this range. So Gold is in a bull market phase. You don't want to bet against it. What's really interesting, Elijah, is when we look at the monthly chart of gold and kind of zoom out on the big picture. I think you and I may have touched on this before, but I use Fibonacci extensions, which is the golden sequence, to identify where price targets for gold are to the upside. And we've hit multiple 100% measured moves in gold over time. And these levels that I'm drawing are kind of where gold has hit rough Fibonacci targets. And what's really interesting here is each time we've hit a target and then gold has blown past it and become that kind of crowded play where we really just see it kind of drift higher and move up. Each time it's done this, including the big one we've seen right now, has been about 22 to 24% move to the upside from the 100% targets we were looking for. And so I find it very interesting that each time we've done this, we've gone into a multi-year pause or a financial reset. And it's not that everybody in the world is like piling into gold. It's actually, a very tiny percentage of most portfolios, of most advisors. But the thing is, people who do hold gold right now, they know we're in a bull market phase and they don't want to sell it. And so it doesn't take much buying for gold to just quickly drift higher, because anybody who has it says, well, I'll sell it to you, but give me, pay me through the nose for it. And so that's why we see gold in these phases here drift higher very easily. So I am, based on that, short-term wise, as I told you, I think there's potential for gold to maybe push a little bit higher. But overall, based on historical price action and percentage moves, it is indicating that gold may have actually kind of had the top here, and we're going to see a bigger pause and correction with the overall economy and the stock market, and pull back and give us a pause. The last time we've had a pause like this, where we went into an economic kind of crisis and a financial reset, was in 2008, and gold pulled back about 34%. So in a perfect world, that's what we'd see here. We see gold pull back with the stock market over the next 4, 5, 6 months, and then gold would probably be off to the races after that. So short term, you don't want to bet against it. It's still bullish, but when you look at the big picture, all the signs are there, including these monthly charts, these candle wicks. If we just zoom in, when price runs up and then gets slammed down and then runs up again and gets slammed down, that's usually a sign that the market is a little bit exhausted. And the big question is this an exhaustion move and it's going to break down and unwind like I think it might? Or is it just a pause, a consolidation before it pushes up for that next leg higher? And that's the nice thing about technical analysis, is we follow price. We don't pick a top or a bottom. We just wait for a trend to start or continue, and then we jump on and trade that. So I'm still bullish on gold, but you got to be aware it is in definitely a unique situation of, there's limited upside and potentially more downside or wasted time if you were to move into it right now. It could take a little while to mature before it has the next big leg to the upside. Percentage wise, it usually falls a lot sharper than gold. Like, you're looking at least twice as much it'll probably fall as gold percentage wise. So it's not immune. It's an even smaller market. Once panic selling hits and there aren't people looking to buy it and everybody wants to sell it, it drops like an elevator shaft. As you can see, it takes a staircase up and then the elevator down. It'll do the same thing eventually. If we do go into a financial reset, it will get wiped out and brought down back to some very, very, I think, critical levels. I think we would see it back down in the low 20s, which would be a great opportunity in the grand scheme of things. If we zoom way back on the silver chart, as you can see, it is a rough ride. Whenever there's panic selling in COVID, we saw it sell off very sharply as well. It creates these short-term opportunities down like 30, 40%. So I believe we could see it back down in these low 20s. And just because it's holding up, as you and I are speaking today, while gold is crashing and falling like 3%, doesn't mean it's immune. It will eventually have selling pressure and the bottom will fall. And it'll become an opportunity to accumulate and stack, build more stacks going forward.
Silver is extending its upward momentum for the fourth consecutive session, trading around $33 per troy ounce during Asian hours on Tuesday. The sustained rally is supported by favorable technical indicators, with the daily chart showing the metal maintaining its position within an ascending channel, a formation typically associated with continued bullish momentum. The 14-day relative strength index has moved above the neutral 50 level, indicating increasing buying pressure and a strengthening bullish sentiment. In addition, silver has managed to break above both the 9-day and 50-day exponential moving averages, further confirming the continuation of short-term upward price action. With current momentum, silver may soon revisit its 6-week high of $33.69, previously reached on April 24th. A decisive move beyond this level could invite additional buying interest and potentially drive the price toward the 7-month high of $34.59, last seen on March 28. Despite the bullish technical picture, some caution remains. Market analyst ChrisVermeulen points out that silver often underperforms gold in percentage terms during market corrections, a dynamic that tends to push the gold-to-silver ratio higher. While this behavior can signal that silver is undervalued and potentially a strategic long-term asset, Vermeulen emphasizes that he does not rely on the ratio as a direct trigger for trading decisions. Let's get back to the interview.
I don't use it for positions or anything like that. I always follow the long-term charts, like the monthly charts of gold and silver, to identify what to get into. So I would think naturally silver will fall a lot more percentage-wise, and I think we'll see this gold ratio stay high or go higher, which is, I mean, in the long term, I think it's a good sign to own more silver. But overall, I don't use it towards any trading. I wait for the asset I like to carve out a bottom, start to trade up and trend up. And then I'll be like, okay, how much do I want to put into silver? How much do I want to put into gold? And then I just kind of go from there. There's a lot going on in these charts. And I've been talking about this for a little while here. This previous high that we've seen on the S&P 500, it's the same on almost every sector and even the NASDAQ. This pivot high I was talking about, the market is going to want to try to run and break through that. And if it does, it's going to create a short squeeze. So everybody betting who's bearish, betting on this market rolling over and selling off and profiting from falling pricing, well, they're going to want to get out because that is a major resistance area. And today's news it's got everybody feeling really good. People went from thinking we were in a, super bearish, markets are going lower, to today, a pop-up on news with tariffs. And now people have completely flipped the script. And they're like, how long until we've entered a new bull market? Like, is it going to start this week or next week? And, things are all good, the tariff stuff. So that it's a big warning sign. And there's a few really interesting charts to kind of share here based around this. If we take a look at, let's take a look at this chart. So the top chart is the S&P 500 monthly chart, and the bottom chart is the same, except for it's where we are right now, 2025. And if we look at what happened in 2008, where the stock market put in a top and then sold off 57%, when we had that first big break to the downside, we saw this blue line spike. And this is, I've overlaid the Google search term bear market of people typing it in, searching. And we've just seen the same thing last month, where the market had its first big crack to the downside. We saw the first real wave of true panic selling. The stock market crashed with 4 days of panic selling. And, if we actually take a look at gold for that exact same time frame, and this goes to show why most commodities and everything are directly linked to the stock market, those 4 days of panic selling were these 4 days for gold. And as you can see, when there is bear market type selling, gold gets pulled back with it. So if we do enter a recession and the market goes into a bear market and a financial reset, I believe gold is going to have a haircut and go lower. But what's really interesting is we have this same spike right now going on of people searching for a bear market. And it's funny, you look online and so many people are saying, well, everybody's searching for bear market. Everybody knows one is coming. That means it's not going to happen. They've already sold and now they're getting ready to buy. But it's not the way that I see these giant cycles, as you and I have talked about, these stages that happen through the market, Elijah. There's 4 stages that you and I have touched on. And more or less, we're in a stage 3 topping phase, and then we're going to go into a stage 4 financial reset. And this is a financial reset is usually global. The whole world suffers. There is no stopping this tide. When the tide is going down, just because we know it's going to go down at a specific time, doesn't mean it's not going to go down because we know it. It's a tide we can't control. And this economic tide, I think, is slowed. And now we're going to see the economy sell off. And just as you mentioned with a potential bear market rally, that's exactly what I think is happening. When we look at the stock market, this is the weekly chart. of the S&P 500. We have bullish environments, bearish environments in 2022. We've now entered another bearish environment, and we're having this dead cat bounce that I believe will eventually roll over and sell off, and we could see a pretty big wipeout. And it's this sell-off here that will suck precious metals down temporarily and give everybody a great opportunity to get into the precious metal space even more. That's my take on where the stock market is and how kind of it relates to where gold is. I think Buffett's probably got a pretty good team of what's going on. We've been raising cash for long-term investing account. We're all cash. I believe inflation is here to stay for a while. I think it could go up. I think interest rates are going to hang in tight where they are or push actually higher and kill the price of bonds. So you don't want to hold bonds. I think there's a lot of downside risk there. I think one of the best plays, one of the most boring plays is simply holding a cash position, earning 4%. If the markets have no real clear direction and there's crazy volatility, as a long-term investor, just sitting on the sidelines, earning interest, even though it may be lower than inflation, it's way better than losing your shirt and giving back 20, 30, 40, 50% of your wealth, and keep that gunpowder dry. So once we do have a pullback and correction, you can load up on gold, on silver, on the companies that you like, and then take advantage of it. So right now it's more so capital preservation, just like Buffett. Cash is a position, even though some people think it's not. And if you don't think cash is a position, eventually you're going to take a hit because you're going to be invested in stuff because you don't like cash. And pretty much everything goes down in a financial reset. And then you'll regret, why didn't I just step aside and, keep earning interest instead of losing everything? I've been pretty bullish on the dollar. I mean, it's been beat up from the tariffs, and a lot of, I think, investors thinking it's putting the U.S. into a worse position, and who knows, probably is or has or done, or I don't know what it's going to do. But in the grand scheme of things, I think the president is trying to make America great again or strong, and he's trying to level the playing fields with tariffs. And I don't know what is right or wrong. I mean, it's a huge game. In order to make things better, sometimes you got to make things worse to get to where you need to go. But I think the dollar has broken that 100 level. Everybody was watching. It made them all bearish and it spooked them out. Huge volume in selling the dollar futures. Everyone was very bearish. Nobody wanted to own it. It broke a couple very significant price levels on the charts from years ago. And that also created more panic. Everybody who's wanted to sell it is now out. It's broken. It's flushed the markets. And I think the U.S. is trying to firm up their country and the currency, and I think the dollar could rally here. So I like the dollar. It does look like it's moving up, and if it does, it's probably going to put pressure on gold. And we have seen the dollar rally very significantly during stage 4 declines. Every time we've gone into a stage 4 decline, the tech bubble, the financial crisis, even COVID, we see the dollar shoot higher. And of course, that's not good for precious metals. So it creates opportunity for sure.
As global financial markets continue to grapple with inflationary pressures, shifting trade alliances, and waning confidence in traditional currencies, gold and silver are assuming more prominent roles. With institutional interest climbing and central banks reinforcing their reserves, the appetite for tangible assets is reshaping monetary strategies. While gold maintains its reputation as a defensive cornerstone, silver's recent technical resilience and industrial demand position it as a compelling counterpart. However, with both metals now approaching critical resistance levels, market participants are closely watching for signs of a broader directional shift. Could the growing momentum behind precious metals signal the start of a new financial paradigm, where hard assets challenge the dominance of fiat-driven systems? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.